Hello ladies and gentlemen, welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. It's Friday and it's the last webinar for this month. Of course, do not be disappointed. We are going to have more webinars next month, future advanced series of course, and you will be able to start signing up for those webinars in a matter of mid next week. However, first, before we actually continue with today's webinar, it's very important for me to mention one more time for those that are just coming on the market, starting to read around the news to see what has happened during the Asian session. Well, the one thing that everybody thought it was impossible to happen, it actually happened. So United Kingdom, British people, voted to go out of the European Union. However, nothing has been written in stone. It's not happening as of yet because, first of all, it has to be approved by the Senate, the Parliament. Second of all, there are a bunch of rules that they have to go through first before the actual exit happened. So right now, they're still applying within the boundaries of the European Union and the laws until everything is down to the piece of paper. So far, what we've seen in the market is major moves over the night. In early Asian session, we saw about 2,000 pips of downside in the British pound. This is the chart. That's the whole move from yesterday. You can see nearly 2,000 pips, 1,800 pips. That's a huge movement down to nearly 32 years low. Well, one thing is sad to say that probably a lot of people were counting on the British people to vote for remaining camp. However, it didn't happen, so whatever bets you might have had on long positions on the British pound, I believe you're kind of disappointed of this decision. Me personally and the colleagues here in the firm, we were trading only yesterday. Today, right now, as of in the next few hours, we're going to start up building our new positions for the weeks and months ahead, as it was, as expected, extremely volatile day, and we simply didn't want to end up in the wrong direction. As these kind of things, as we know, nobody can predict precisely with, especially when it comes down to the opinion and the decision of normal people like us that want something different or something else. So basically, that is about it. As we've seen for the past 8-9 months, a lot of different things happened. We're writing new history. For some of us, and those guys that are here today, and you guys especially, that are seeing things like these happening on the market for the first time in your entire life, simply because you're too young to have experienced, turmoil on the market, like let's say the world crisis in 2007, 2008, stuff like that. So basically, those kind of things that are happening today will actually provide the future market direction from now on. Now, what is going to happen is actually all for the best, looking from the perspective of United Kingdom being out of the European Union. So it will be much easier for the United Kingdom to actually spur growth as to from a political and economical perspective, of course, definitely because the environment over there will not be so much dependable on the European Union. However, on this type of hand, speaking of European Union, now the confidence right now of the Union itself has been shaken a little bit. A little bit is probably a very, very soft word that I'm using, But given the fact that a major economy, or a strong country with expensive currency, one which has been seen as a reserve currency, is going, have voted to go out of the European Union, which in result, as we can see all around the market, the euro declined versus the US dollar as well, with about 400 pips. If we measure the full move, is nearly 550 pips over there. Gold has risen since yesterday's low with about, what, $100. Speaking of the move, only the move itself is about $80 to $90 right now, still about $50 higher since yesterday's, since the opening of today. So, let me see here. The Japanese yen also went higher versus the dollar. If we measure the full move, is about closer to 800 pips. So all that we're seeing here is only due to the vote that was 52% in favor of the Brexit against 48% to remain in camp. Now, all of these moves, as we know from technical perspective, as we are slightly moving into the today's topic, they all have to have retracements. As speaking of retracements, we need to know how much in percentages. So it is a very good opportunity today. It so happens that we speak about retracements of the recent volume, recent extreme moves. We need to know with precisely how much that retracement is coming, which are the targets, what would be the possible, support or resistance levels, because right now, from here on, we're not so much data dependent or, let's say, politically or economically dependent on what is actually going to happen on the market, rather than being more of a technical trading from now on, because we already saw Britain going out of the EU. We saw the US rising interest rates last week, disappointing numbers from United States again, and the jobless claims. Also, we were seeing a little bit of dovish tone from Fed Chair Janet Yellen. Also, on top of that, in connection to the Brexit, this is also shaking the world economy as well. So basically, the Fed might be holding on to raising rates in the near future for a very simple fact that an event like what happened throughout the night is something that we're witnessing probably for the first time in the history of our world, modern days. So all of that will get them thinking maybe we should wait a little bit so we can see better numbers. Maybe we can see the UK economy reviving a little bit, because everything is dependent. We're like every neighbor. If you live in a house, a beautiful house, 2, 3 floors, doesn't matter. 1 square kilometer of forest, for example, or you just live in a normal flat with neighbors all around you, you are dependent on those people that live together with you to keep the things in order, because you're not the only one there. And whether it's going to be clean, whether it's going to be a friendly neighborhood, so on and so forth, all of this depends on the neighbors that you live with. And it's the same thing when we speak about different countries like Germany, France, Italy, UK, for example. All of these countries are neighbors within a certain union. However, one is already not part of the union, not officially, which means that whatever country decides to do something, whether raising interest rates, lowering interest rates, they are taking an example from other countries to see how the economy is developing over there, whether the trading economy is actually going to be okay, in a post-rate rise or rate decline. All of these things are not only down to one country, but we are all in this world, involved in everything. So when we get all of this out of the picture and we are strictly down to technical trading, which we pretty much endorse and value by far the most, because we just want to get rid of the psychological element of the trading out of the picture, so we can go down to our normal technical trading. And the retracements that we spoke about earlier, ladies and gentlemen, are extremely important in any particular system that you use. So in today's webinar, we're going to talk about the type of system which can be also used in a combination with other systems, or the one that we spoke about the last time on Wednesday, a dual stochastic Forex system. This is the so-called overlapping Fibonacci system. Or we're going to talk about more than one Fibonacci retracement tools on our charts, which we can use as a standalone trading for higher time frames, when we have to decide when to trade, of course, going down to smaller time frames. Everything will come down in a few minutes and it will be very clear to you. But it'll be the combination with any other system. It is also a very useful tool because it actually narrows down the point from where you should start watching for a particular good opportunity to enter the market, not just enter higher, so the market retraces down and then just starts climbing higher. So all of these things are important in order for us to make substantial profits and reach our goals. However, a single Fibonacci level may be sufficient, but when we have two or more retracements or type of extensions, in the so-called confluence, is a very mighty combination when it comes down to technical trading. As we speak about technical trading, the concept of the overlapping Fibonacci Forex system is one of the most that traders come to use after having used one Fibonacci retracement at a time. Typically, the way we're going to use those Fibonacci extensions or retracements, we're actually going to look for a confluence of Fibonacci levels with other signals as well if you're combining it with another system. Appropriate system is also the dual stochastic trading system, to reach a higher potential or higher certainty of any trading signal. That, of course, will give us support levels, resistance levels, which are much more accurate and much more strong. Also pivot points from where we can expect breakouts, reversals, so on and so forth. Because very often we have seen on the market that in order to make a good trade, we need a strong level to be broken, whether it's support or resistance level. It's not only down to the, let's say, the particular support levels that we normally see, like these, levels like this one, for example. It's also looking a bit like a very strong resistance or support level. Saying this one, for example, looks very strong here because the price has had difficulty breaking down, so on and so forth. But actually using more than one Fibonacci will give us the opportunity to measure the type of retracement which we've had in the terms of this trend, short-term trend, this downturn trend here, and not only, but we definitely have to take a look at the bigger picture. It seems to have some kind of a Fibonacci retracement here for quite some time. It's been 2008 since I've been measuring something here. So I'm just going to get rid of it, only to not make any type of problems within our next possible trades. This particular trend over here, as we can see, and if we go down to the daily chart and zoom a little bit out, we can see that there is a type of trend here for about a couple of weeks or something that has made some particular strong upside. Now, I'm not going to just go with any more Fibonacci's, but you can actually choose as many other as you want. You know, you can measure this small trend here, that small trend there, this one as well, but it really doesn't come that much to that. But rather than measuring the major moves, the strong moves, as we see. So when we go down to a more smaller time frame chart, what we see here, ladies and gentlemen, are those things that we need. The confluence, or the so-called a lot of Fibonacci retracement in percentages, very, very close or at the same level at each other. As you can see, this one here, and this one here. So those 1, 2, 3, 4 levels are extremely important with those retracements that we measured in the past. And what we're trying to say is that initially we actually have decided that there has been type of support or resistance, strong levels around, you know, the candlesticks that have had problems breaching certain levels. We have been right so far for 2, but as you can see, more have actually come to be. As well as this one wasn't extremely relevant, however, this one was. And what we have in the end is the so-called strong levels which we need to take under consideration, while of course removing those Fibonacci retracements and leaving only the big one here, which is also an important one, so we can take its levels to trade. If we shrink that chart a bit, and let's say we're mid to long-term traders, so we're actually going to be looking for a type of trade that will give us a profit in a matter of 1 to more thousands of pips of profits. Okay, you know, if we are actually going to be trading on a smaller time frames, the same rules apply. But then on, we have to take the smaller trends, this one, for example, from here to here, from here to here, in this one here as well, and then move down to the 1-hour chart and do the same as we did right now. But that example I will show you in different instruments, let's say gold, probably the pound versus the dollar, so on and so forth, so we can see exactly what we have. But even in this condition, in these levels, we can see that in particular, those green lines that we already measured are a particular target when we trade. We see that here the price had extreme difficulty in moving higher, sustaining the level up. You can see that here as well. Once it's been broken, a very strong movement brings down the price to that particular level and here, and it's even aiming for the next one here. But it didn't reach it, which definitely tells us that sometime in the future it will try to touch that level and break it. Because past performance, as we mentioned before, suggests future behavior. This is what we do when it comes to technical trading. We always need to evaluate historical events in the charts in order to be able to predict future price movement. And not only, but as higher targets, future targets, we can always take those yellow levels of the Fibonacci retracement, which are the levels of the major downward trend, which are definitely in a very long time in the future play a huge role within our trading. And as you can see, in the past, the price have tried multiple times to come down to that level. Even if it didn't manage to break it through, that doesn't mean that it's not going to try again. Simply because we can expect, you know, in the future, probably with more rate hikes from the side of the Federal Reserve, let's say, which might be able to bring down to a parity between the euro and the US dollar, which of course in in general might even drive the prices down here, which is 1-to-1 exchange rate. All of that gives us powerful levels that once broken and sustained in a combination with, let's say, chart formation, candlestick patterns, other indicators that we spoke before, all of that makes a great and powerful system, and of course, most of all, reliable. Speaking of smaller time frames, if you don't have a very big balance, so you can't really sustain, let's say you have seen that the prices multiple times try to break and sustain this horizontal line level of the price of 1.1377. Okay, that's a significant level. We have seen that multiple times it's been broken, and then from here, 3 sessions at a time, one after another, that level has rejected the price. But if we're targeting this one and this one, we might need to sustain the negative trend for quite some time, and that's 250 pips. So basically you might not have the balance in your accounts that will allow you to sustain that particular trend. Therefore, we move to smaller time frames, and for that example, we can take, let's see, gold. Now, having the opportunity here to measure particular movements in gold price, we're going to take from the start of this trend, that would be our first. Now, moving backwards, as we can see, we're not starting from far behind, but we're actually moving from front to back, because we need to see those candlesticks, those levels, much more clearer. And when we move backwards, those Fibonacci retracements are staying behind us. But when we move back, we're going to see this confluence that we need. So we're taking also this trend here, which is also very important. We can take this trend here, which is very important. And okay, let's take another one, which is, let's say, this one here. What we see here from the first glance is very, very strong levels confluencing around this. Not so much on this one, but we're still going to have it as a target. Those here, as we can see, the price has been very, very choppy. So we're actually going to mark it as a zone which is the most inconvenient for us to trade. And that particular area is about $20 range. And we're actually going to take these levels here, and that level here, which is particularly interesting only because of the 2 100% retracements as numbers. So what we need to do next is just go forward, try to zoom in a little bit, not too much of course, and try to place same horizontal levels as we've made before here. You don't have to be extremely precise in these conditions. Rather than that, you might just take 2 recent peaks, okay, like these 2 candlesticks, and mark that level here on their closings. Also, on the next one, we're definitely going to take this level here because those are very close one to each other. Here, as we mentioned, we're going to mark it with, you know, we can take it as a range with levels, horizontal lines, which are different colors, for example, or a rectangle. That can also be done. Let's see how we do that. We go to Insert, Shapes, and a rectangle. So this one we can mark like this, and we can have it for some time later on. Now, why we do that? Not only just because the price is about $50, $70 higher right now, but in the future, these levels are going to play a good role for our future trading. Not only, but simply because in the time when the price develops, a new trend will appear, and we will actually mark that one as well. And we'll see whether we should just start moving up or down just slightly so we can have much more accuracy on today's market. And of course, we're going to take this one here, like that as a significant level. And if we're actually going to be moving down to 1200, which at this stage is not going to be anytime soon, might be this one here, but what we're interested in mostly is the smaller time frames. Before that, however, let's erase all of these, like this one here, this one here. We delete it. One more is left, this one here. And we go down to the 1 hour chart. Okay. These ones are also going to be erased like that, so we don't really need that. All right, what do we see now here? We see 1, 2, 3 lines which are very close to our current price. We're talking in terms of 1 hour chart and 4 hour chart. This is where we're going to focus, as our technical analysis is focusing on that 4 hour chart. Now, if we're going to be trading on 30 and 15, we're going to be making it on the 1 hour chart. And then this trend will be valid. This one here will be valid. Let's see. From here to up here will also be valid, because that's a longer term trend in the midst of the time frame as we speak. So you get the picture. Right now, what we're expecting, is a break below this area will bring the price towards this level. That's one of the significant levels. However, what I made is a mistake here. Nobody actually corrected me, but that was me not leaving the major trend on this chart, which is that one. No, sorry, I apologize, this one. And it's this one here. That's the major trend down, simply because we're looking for a trade to the downside. If we're going to be looking as a trade to the upside, we're always going to take the recent move, which is this one, as potential targets in the near term. Switching back to 1 hour chart, what we have is our pivot point at 1290. We can see the confluence here between the many lines. We also see 38.2 level to the downside is going to be very significant, as we mentioned earlier. A break below is going to be taking it to the 50 level and then towards the 1290, or the so-called 0 or 61.8 on the previous trend. But if the price for some reason drops down within that rectangle, this is where we are not touching that particular instrument, and we are focusing on something else. Because in this way we are protected, because ending up in a range so tight, in a choppy trading in the not so far away past, so to speak, we might even end up into in a locked position for a long time with no profits and high risk in losing money within our accounts. Now, speaking of terms of a sustained trading above this 38.2 level, with a session close, that will definitely be aiming for the 23.6. We're looking at $15 in terms of gold price to the upside. Up to the 0 level, that's in total of $40. And if we are partially taking profits, $26 of profit, so on and so forth. If that level is not sustained, next downside, $11, next one, 24 in total, or pretty much in the matters of $11 to $13 of profit each. And if that level is also broken, this would be the final potential target, and we're not even going to be leaving it for the next one because of that blue rectangle telling us danger, do not trade within it. Let's have a look at the GBP versus the US dollar. Here, however, we're going to be looking at even a smaller time frame, where we're even going to be taking this recent move to the downside. Let's say we expand a little bit so we can take that trend and it's beginning from here to here. Also taking this trend and it's beginning from here to here, and one a little bit back, which would be the major one from here to here. And those are only the Fibonacci retracements that we will use so far. What we see on a first glance, as we mentioned, we can even zoom in a little bit so we can better see what's happening here. We have the same type of rectangle appearing over here within the midst of 1.44 and 1.46. We can do the same thing as we did with gold by applying this rectangle like this. For future references, telling us that within these ranges it might be a lot of choppy trading, so it's not really worth our time. Here is a good level. This one, definitely. This one here, we're not taking it because it's the final level here. We're only using it as a potential break above this level. Here, this one, we're going to take. As we can see, this is from the gap here that occurred. This is also an important level. This one, and of course, the final one, which will be that one here. At the end, let's have a look at what we have on that chart without using these Fibonacci's. However, what we're interested in is having the major trend still here. Therefore, we're going to leave it like that. And this would be our chart that we will be trading. Now let's see here. Our current price is over here. We see that this major rally drove it there. So what is the important here in this chart is that this trend, that's why I left this Fibonacci, is because of the one that we're actually going to be trading in. We can see that 23.6 points down, breaking down, points to a continuation down to the zero level, because that's where we're going to be cashing in. We're not going to be taking any midpoints, of course, unless you are a conservative type of trader and you want to split it on two. That's also something that you can do. With another bounce off like this, we're going to be targeting 32.8. With the breaking of this level, we're going to be targeting the 50 level here, and also small portions. Because of these tight resistance levels, we're going to be partially cashing out here, here, and somewhere here. Maybe I would even just go all out over here somewhere, only because we're getting very, very close to that rectangle, and we don't want to do that. But simply, as we know what is happening with the pound right now, we might even just want to lay it out for, let's say, a couple of days, maybe a week, so it can settle up. Probably is going to find some bottom over there, as we know, because it's getting very, very depreciated. Therefore, this is only an example for smaller time frames. If we are looking for even smaller, quicker profits, this is what we get. When we reach that bottom here, from where we started drawing that Fibonacci, we get first target there. We see that it had a few times difficulties. We see that hammer appearing. So the first position drive is here. We see that it's not breaking. It's not sustained. Therefore, second position comes here. That's in a matter of 200 pips. You see, that's a very, very severe move, especially for the 15-minute chart. So speaking in terms of profits, when we see so severe moves, such huge volatility, we might even going to get to choose for smaller time frames to get to do this one like this, and just about start cashing in the middles here. We can see the area between 38.2 of the new Fibonacci retracement and the 50 is a danger zone. So basically we're going to be cashing in here, and if it starts dropping, we're going to be opening from here to here and then down here. All of these technicalities, the small things that are very important that you have to calibrate when you just, start going in within the market, you are actually going to be doing down the road. And as we're, getting on a smaller time frame, even when we speak in terms, you might even, you might even want to put another Fibonacci on this one here and even get something for scalping. Of course, you might need to zoom in a little bit more so you can see better. But this I wouldn't even go so far. It's just too much. I would even keep it with the 30-minute chart. It's much more convenient. It's less choppy. It makes very good large candlesticks on where you're going to be cashing out or entering your positions, which makes it an extremely valuable type of system. You can use it as standalone. Also, you can combine it with another system by your own choosing, or the one that I recommended the last time as we spoke, which was the dual stochastic. And one more time to remind you the parameters, 5.2 on the fast stochastic, and the slow stochastic parameters 21, 4, and 10. All of these with fixed minimums and maximums are 0 to 100. You can also take as more aggressive trading, the smaller levels like 20 and 80, and a midpoint of 50. That's also by your own choosing. Well, ladies and gentlemen, that was all about today's system. A very pleasant system that you can incorporate with any other, gives you much more accuracy on your entries, and you can customize the levels of the Fibonacci by your own choosing, your preferences. If you want to use the 33% retracement, then a 66 is also appropriate. To be honest, it's not really necessary. You can always go on with the default levels, as we're taking pretty much an average type of horizontal lines where we're going to be entering and exiting. That's all about it. Thank you very much for joining us. I'll see you next month in our advanced series of webinars. The new topics will be uploaded as soon as mid-next week, so you can start getting on board. Of course, here is the time where I should remind you that probably, not 100% certainty of course, but probably throughout the month of August, we're going to take a break with our webinars and start early in September, in the autumn, basically because we're still going to need a little bit of break from the so much exhausting type of market as we can see it from the first and the second quarter of this year. It was a pleasure for me to present this system today. Thank you for joining us. I'll see you next time. Bye-bye.